Every time you tap your card to buy a coffee, a fraction of a second passes before a beep sounds and you walk away. In that split second, an invisible hand reaches into the transaction to take a cut. Two companies started as bank experiments and grew into the owners of the global financial infrastructure. They do not print money or even lend it. They simply own the road the money travels on. For decades, they have charged a toll on almost every dollar you spend. Visa and Mastercard have effectively seized control of global commerce.
Sure. Look at me, sure. I'm the captain now.
You likely have a card from one of them in your wallet right now. In the United States alone, Visa controls 52% of all purchase volume, while Mastercard handles 24%.
Inevitable.
Together, they form a nearly inescapable market dominance. Merchants cannot afford to turn them away, and banks must issue their cards to remain relevant. They sit in the middle of a four-party system involving you, your bank, the merchant, and the merchant's bank. Their job is simply to verify funds and move data. For this service, they have built businesses with profit margins that would make a tech giant jealous, often exceeding 50%.
$1 million.
It is the perfect business model, where they build the bridge once and charge everyone to cross it forever. The empire began with a stunt that would be illegal today.
You're not giving it to me! Give it to me faster! Wait.
On September 18, 1958, 60,000 residents of Fresno, California, opened their mailboxes to find a plastic card they had not requested. Bank of America had simply mailed active credit cards to the entire town in an event called the Fresno Drop. Before this, credit was a fragmented mess of store-specific accounts, like a tab at the grocer or a card for the gas station. Bank of America had the idea for a single card for everything. It was a disaster at first because fraud skyrocketed and delinquencies hit 22%. The bank lost $20 million.
Bankruptcy!
But the idea stuck. Customers loved the convenience, and merchants loved that the bank took the risk of non-payment. The Bank AmeriCard was born as the ancestor of Visa. Success breeds imitation. Seeing the potential monopoly of Bank of America, a group of rival banks banded together in 1966 to form the Interbank Card Association. They bought the rights to a brand called MasterCharge, which featured two interlocking red and orange circles. This was more than a product because it acted as an alliance. Bank AmeriCard was originally owned by one massive bank, but MasterCharge was a federation. This forced Bank of America to give up control and spin off their card into a separate entity called Visa in 1976. The two networks spent the next few decades racing to sign up banks and merchants around the world. They fought for the banks that issued the cards rather than the customers directly. By the time the internet arrived, the duopoly was already cemented in plastic. The secret to their wealth is that you do not pay them directly. The merchant pays them and then charges you higher prices to cover the cost. This is called the interchange fee. Every time you swipe, about 2 to 3% of the transaction vanishes. The network sets this rate, the merchant's bank pays it to your bank, and Visa or MasterCard takes a slice called the network fee. While it sounds small, 3% of the global economy is an astronomical number. In 2024 alone, US merchants paid over $100 billion in these processing fees. This system incentivizes banks to issue more expensive rewards cards because those cards carry higher fees for the merchant. Your airline miles are not free because the coffee shop owner is paying for them. Tech companies have avoided building cheaper networks because almost all previous attempts failed due to the network effect. A merchant will not accept a card that nobody carries, and nobody will carry a card that merchants do not accept. Visa and MasterCard solved this by getting the banks on board early. Discover tried to break in by offering lower fees, but they could not get enough traction with issuers. American Express took a different route by acting as both the bank and the network, with a focus on high-spending business travelers. Even Amex has only a fraction of the global acceptance reach of the two leaders. The competitive moat is so wide that When Apple and Google entered the payment space, they did not build new rails. They just built digital wallets that ride on the existing tracks owned by Visa and Mastercard. Their biggest competitor has never been another company, but rather physical cash. Cash is anonymous, instant, and free for the merchant to accept. The duopoly launched massive marketing campaigns framing paper money as dirty and slow to defeat it. They pushed for contactless payments and small-ticket acceptance so that people would use cards for minor purchases like gum.
All right. And at an average of 2.25% interest over a period of 1,000 years, that comes to 4.3.
The result is that cash usage has plummeted, and in countries like Sweden, it has almost vanished. This shift was engineered rather than accidental.
Your fleet is lost, and your friends on the
Every dollar converted from physical cash to digital data is a dollar they can tax. They have effectively privatized the currency circulation system of the world.
Regulators watched from the sidelines for years until the atmosphere shifted in late 2024. In September, the U.S. Department of Justice filed a landmark antitrust lawsuit against Visa that specifically targeted its monopoly on debit cards. The government alleged that Visa punished merchants who tried to use cheaper routing networks and paid off potential competitors to stay out of the market. Visa called the claims meritless, but a federal judge rejected their motion to dismiss the case in June 2025. This ruling signified a declaration of war rather than a simple warning.
Boy, that escalated quickly.
The DOJ aims to break the exclusionary contracts that have kept the duopoly safe for decades. The toll booth operators are finally facing a threat they cannot simply buy out.
I'm in danger.
While the DOJ attacked from one side, merchants attacked from the other. A class action lawsuit that had lasted for 20 years seemed to end in early 2024 with a $30 billion settlement offer from Visa and Mastercard. Although the number sounded huge, retailers realized the relief amounted to a tiny fraction of a percent in fee reductions for only a few years. Judge Margot Brody rejected the deal in June 2024 and called the relief paltry. By November 2025, a revised settlement was still being debated by trade groups like the National Retail Federation. They call the deal smoke and mirrors. The merchants want the right to steer customers to cheaper payment methods rather than just a discount, a power the duopoly fights to keep. The market shifted again in early 2025 when Capital One received stockholder approval to acquire Discover for $35 billion. This was the biggest shakeup in payment history. By combining the massive card-issuing power of Capital One with the independent network of Discover, they created a vertically integrated giant capable of challenging the duopoly directly.
I have come home.
Regulators and executives watched closely as the deal moved toward closing. If successful, this merger creates a third competitor. While the giants fought in court, a quiet change began in the wiring of the U.S. banking system, called FedNow. Launched by the Federal Reserve, this system allows money to move instantly between bank accounts 24/7 for pennies. There is no Visa, no MasterCard, and no 3% fee involved.
You might like to hear this free real estate.
It's free. Real estate.
We're giving you land.
It's free.
We're giving you a
Adoption was slow at first, but volume exploded in 2025 with 49,000% year-over-year growth. It is the beginning of account-to-account payments in the US. In countries like Brazil, a similar system called Pix has already decimated card usage for small transfers. If FedNow reaches critical mass, the card networks could be bypassed entirely, and their valuable toll road could turn into an abandoned highway. The United States is the stronghold for the duopoly, but the rest of the world is rebelling. UnionPay dominates in China by handling nearly $7 trillion in volume, which is technically more than Visa, despite being mostly domestic. The Unified Payments Interface, or UPI in India, has made card payments look outdated.
Hey son, what you doing?
I'm having a tea.
You scan a QR code and the money moves instantly for free. These state-backed systems prove that you do not need a private duopoly to run an economy. Visa and Mastercard know this. They have tried to buy their way into these markets, or partner with the local players. But national governments increasingly treat payment rails as public utilities rather than private profit centers. Visa and Mastercard have changed direction facing these threats. If they cannot stop the new technology, they buy it.
Modern problems require modern solutions.
They have spent billions acquiring fintech companies, fraud detection firms, and open banking startups. Visa tried to buy Plaid for $5 billion in 2020, but the DOJ blocked the move because it would have neutralized a future threat. They shifted strategy and now pitch themselves as networks of networks, serving as the security layer that sits on top of all these new payment methods. They are terrified of becoming the dumb pipes of finance, where the value is created by apps while they just move the data.
It's my purpose.
You pass butter.
Oh my god.
Yeah, welcome to the club, pal.
There is another revenue stream that is less discussed but equally lucrative involving your data. Every time you swipe, you generate a data point regarding where you shop, what you buy, and how much you spend. Visa and Mastercard aggregate this information and sell insights to retailers, hedge funds, and advertisers. They do not sell your name directly, but they sell the patterns. If you are a coffee chain wondering where to open your next location, Visa can tell you exactly which block has the highest caffeine spending. This data monopoly creates a secondary defensive wall. Even if a competitor offers cheaper fees, they cannot offer the deep intelligence that comes from seeing half the world's transactions. A major part of their power is a clause in their merchant contracts called the Honor All Cards rule. It means if a bakery accepts a basic Visa debit card with a low fee, they must also accept the ultra-premium Visa Infinite Privilege card. The premium card charges the merchant a massive fee to fund the champagne lounge access for the cardholder. Merchants hate this because they want to say yes to the cheap cards and no to the expensive ones. But the contract says it is all or nothing.
This deal is getting worse all the time.
This rule is currently under fire in the ongoing litigation. If a judge ever strikes it down, the entire rewards card economy could fail rapidly. The duopoly faces a dangerous moment as 2025 ends. Their stock prices are still high and their margins are still fat, but their foundation is weakening. The DOJ is circling, the merchants are rebelling, and technology is finally offering a real alternative. The plastic card itself is disappearing as it gets replaced by phones and watches, and soon, perhaps, by biometrics. Visa and Mastercard are racing to ensure that the signal still routes through their data centers, whether you use your face, fingerprint, or phone. They have survived for 60 years by being the only road in town. The question now is whether they can survive in a world where anyone can build a highway.
¿Está claro?
We accepted the hidden tax of the duopoly for half a century because it bought us convenience. In an era of instant digital transfers, the idea of paying a 3% toll to move our own money is beginning to feel obsolete. The dominance of the networks is fading. Whether the change comes from a government lawsuit, a rival merger, or a new technology, the era of the silent toll booth is coming to an end. If you want to keep following the money, make sure you are subscribed.